Morning, market chameleons and Mr. Dimitri Pargamanik. How you doing this morning, buddy?
Good morning, Will. How are you doing?
Sorry for turning on right at 9. That doesn't typically happen. Let me share right away. We'll get going.
Okay. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions, provide you with guidance. There's the disclaimer.
Excellent.
All right. And let's
What's moving in the pre-market?
started. Yep. So I think what we'll do today is take a look at what's moving in the pre-market. We'll take a look at, I think we're having earnings coming up in the next 2 weeks. We'll see what's coming up in the next couple of days, actually, and what the options are implying as far as the move in either direction. Then we'll take a look at maybe some bullish bearish ideas. And if you have any questions along the way, Will, let me know. I'll try to, get to those questions first. So this is the pre-market report. We have stocks trading in the pre-market hours, the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to take a look before we actually look at the higher market cap stocks. One of them just right now is jumping out at me is MARA. It's down 17%. And I think we talked about this stock. It's
I think they're in the Bitcoin space or the cryptocurrency.
They're in the Bitcoin space, exactly. So what they do is mine digital assets. So I guess that there's a whole business where you're part of that blockchain. You keep your servers going, and then you get rewarded after a while with a little bit of Bitcoin or whatever cryptocurrency you're dealing in. And just what's interesting about this is, how you hear people, even Warren Buffett, saying, well, if I could short every cryptocurrency, I would just short them all because they're going to go to zero. Of course, I don't think you could. Maybe you can now with the futures.
Well, there are futures contracts. Yep.
There are future contracts. So you can, I think, go short them with the futures. But obviously, stocks like these, you would think if the cryptocurrencies go to zero or collapse, also stocks like these stocks would suffer as well. And you see here, so far today it's down 16%, but we could see here still it was trading near its 52-week high yesterday, $26.15, closed up yesterday, high 28.37. You could see the low, 52-week low, 35 cents. So it's come a long way. But just that one stock. Actually, while I'm on it, let's just take a look at what's going on in the pre-market hours in this stock. And then we'll move on. So over here, we see the stock yesterday closed at $26.15. It was up 11%. Today, trading $21.73 in the pre-market hours. That's down 17%. Here's the VWAP price, pre-market 21.47. Traded 4.7 million shares in a pre-market, a float of 62.5 million. So pretty active in the pre-market hours. And I don't think it has a big history, but let's just take a look historically what happened to the stock when it had a big gap down move in the morning. So this is looking at the 12 largest gap moves in the last 3 years to the downside. And down here we have the dates. These are the percentage moves to the downside. So you see on average down 18% compared to today's 17%. So kind of in line with this. This is what it tended to do after the opening. So from the open to the high of the day, the average move was 16.2%. From the open to the low of the day, the average move was negative 6.6%. So at least as far as the magnitude of the move to the upside versus the downside, looks like much more favorable to the upside. By the close of the day, it looks like it tended to drift higher a little bit more often than lower. 58% of the time it closed higher, 42% lower for an average gain of 6.3%. If we just took the magnitude of the move from the open to the close, on average, when we're looking at either direction, on average, up or down 11%. With a high move of 38.7. So you can see it's pretty volatile. Even after the open, can move on average moves 11% in either direction. So that's really quickly a historical price return distribution in MARA after a gap move to the downside. So I'm going to close that up. If there are no questions, let's take a look at what's going on in the higher market cap stocks today. So let's take a look at stocks 20 billion or higher. So I see 19 made the percentage gainers list, 14 percentage decliners list. Plug, now, that's been running already for what, like 3-4 days straight, up 6.4% in the pre-market hours. We're talking about it a little bit yesterday, $30 billion market cap. And not too long ago, what was that stock was in?
Yeah, I think it got down to $2 we were talking about.
$2, right.
By the way, that Morrow you were just looking at, its 52-week low is 35 cents.
Yeah. Yeah. All of a sudden, yeah, it's like way up there. Of course, so the digital currencies are rallying as well. So I think they make more money as the currencies are going higher.
Well, they operated a loss at some price in the currency, keeping the server farms on, trying to do these calculations to mine isn't worth the energy.
Profitable.
Yeah.
Right. Yeah, they need a certain price level and probably a certain volume in that currency. But here we go. Plug up 6.4%. They're into the alternative energy. I think what are they doing? Like hydrogen?
It was the hydrogen. Actually, Len mentioned yesterday on the chat, I don't know if anyone saw it, but the only discharge is actually water.
Yeah, so that's pretty amazing, right?
if it works, yeah.
You would think that would be the most preferable, even to the batteries. That would probably be more preferable. But General Motors up 4.2%. I think General Motors is also, they have a lot of in-house technology, I think also working with hydrogen.
Probably many of the chameleons were talking about this like 8 months ago, that there was talk of General Motors actually splitting off their EV unit to try to get full value for that piece of their business.
Right. So if you separate it, it's worth more than if you could keep it in-house, all in one company.
That was the discussion in the chat, as I recall, and certainly it's been discussed in the news as well.
Right. So that's up 4.2%, 64. Let me just see what the 52-week. So here's 52-week range, $14.33. Trading right now. If it opens at 49.80, that'll be a 52-week high. Let's take a look at that gap history. While we're on our General Motors here, closed 47.82, trading 49.80 in a pre-market, up 4%. VWAP $49.65. Let's look how this tended to perform after gapping up in the morning. Again, 12 largest gap moves in the last 3 years. Here are the gap moves, the dates. So we see on average 7.6% versus today's 4.1%. So, this would be on the lower end of these. But this is what it tended to do after the open. From the open to the high, average move up 3.2%. From the open to the low, average move 3.9%. So a little bit more skewed to the downside. From the open to the close, tended to close higher more often than lower. From the opening price, 67% of the time higher, 33% lower, average gain of 0.8%. As far as intraday move from the open to the close, in absolute terms, up or down 2.9%. So you can see still could be pretty volatile, almost 3% up or down with a high move of 7% over here on March 24th. So really quickly, that's price return distribution after a gap move to the upside in General Motors. Let me close this up. If you don't have questions on the pre-market, I'll just move on to the earnings.
Well, it's a little bit of a delay. Let me see. Yeah, you're good. Move.
Okay. Let's take a look at earnings coming up in the next 2 weeks. So Here's the upcoming earnings analysis. I'm going to look at the full report here. So this is a list of stocks that are expected to report earnings in the next 2 weeks. I'm going to use this filter to look for stocks that on average trade 5,000 option contracts per day or more. And here we have that meet this criteria. We have 2 expected to report tomorrow before the market opens, APHA, DAL. So let's take a look here. APHA, the straddle, as of yesterday's close, is implying a move of up or down 11%. Remember, you're buying the call, buying the put, that's a straddle. So in either direction, 11%. That compares to a historical 4-quarter average move, 12.4%, and a 12-quarter average move of 16.9%. So we're 1.4% below that 4-quarter average right now, and 5.9% below the 12-quarter average in that straddle. And we see here the high move in that stock, 41% in the last 12 quarters after reporting earnings. And here it does seem, it's a little bit even below what a usually implied move. DAL, expected move right now, expecting to report earnings tomorrow before the market opens. The straddle's implied move 4.3% in either direction. That compares to a 4-quarter average move of 2.8% and a 12-quarter average move of 2.4%. So we see 1.5% above that 4-quarter average, 1.9% above the 12-quarter average. The high move in DAL, 4.8% in the last 12 quarters. Let's take a look at Citigroup coming up. That's not tomorrow, but Jan 15th before the market opens. So we could look at it tomorrow as well, but let's just see where it's lining up today. So far as of yesterday's close, straddle's implied move 3.8%. That compares to historical 4-quarter average 4% and a 12-quarter average move of 2.3%. So kind of in line with the 4-quarter average, 1.5% above the 12-quarter average. High move in Citigroup, 5.6%. Let's do Wells Fargo and JP Morgan. Wells Fargo, straddle's implying a move 5.1%. That compares to a 5% 4-quarter average move and a 3% 12-quarter average move. So in line, again, kind of similar to Citigroup, in line with the 4-quarter average, 2.2% above the 12-quarter average. High move in Citigroup, 6% in the last 12 quarters. JP Morgan, straddle implying 3%. And these are all coming January 15th before market opens. Straddle implying 3%. The 4-quarter average move, 1.5%. 12-quarter historical average move, 1.8%. So we're 1.4% above 4-quarter average, 1.2% above the 12-quarter average. High move in the last 12 quarters, JP Morgan, 4.7%. So there are no questions, Will. Just kind of move on to the next report.
No, that's great, D. Listen, just a quick question. You may know this. With the ultra products, the rule of thumb is you don't want to hold them as a long-term investment because their structure leads to a natural decay of the ETF in value. Do you know why that is?
So the way that the ultras work is that when you look in finance and we talk about movement, stock movement, especially like how you would see this in financial models like Black-Scholes, binomial, you would use log returns, right? And a log return would basically say if the stock went from 100 to 110 back to 100, the log return would be 0. But these ultras, they're using simple returns. Okay, so what they're doing is following daily simple returns, and that's why they lose or decay in value over time. Okay, so for example, if a stock goes up 10% from 100 to 110, that's a 10% gain, right? But when the stock goes from 110 to 100, that's not exactly 10%. So when you're doing simple returns, they're not additive. Does that make sense? Like simple returns are not additive. Log returns are additive. Is that confusing?
It is. I must say it is a little bit for me, but I always thought it. I mean, and mentally, I thought it was basically because they were playing in the futures market and they had the role in the futures. But you're saying it's actually the structure of the entity.
It's the way that they track. So they track daily returns, right? Think of it this way: they track daily returns every day. They reset and they track daily returns. So think of it this way: if a stock starts, if you start at 100 and you're down 10%, right? Let's say you're down 10% the first day, so it goes from 100 to 90. You lose $10. Well, to get back from 90 back to 100, you need more than a 10% return, right? 10% would be only $9, right? If you start, so every day they reset and they follow a daily simple return. So when you go down 10% and then you go up 10% the next day, right? Based on simple returns, you're actually at a lower price, right? So simple returns are not additive. Does that make sense?
Yeah.
Hopefully that's what, but you could read the prospectus. You'll see every day they reset and follow the simple returns. That's why they decay. They decay over time.
Yeah, there are chameleons out there that say you and Dr. Chameleon, aka Jake, should be working on a corona vaccine. That was a good explanation. Thanks a lot. Listen, when you go over to earnings, Pavel, our chameleon boots on the ground in Europe, is asking if you do look at earnings, could you maybe look? Dan was talking about, I think, time spreads around earnings. I don't know if there's anything you can look at in time spreads, but Pavel was asking about that the other day and is asking again. So
let me see. Let's take a look at one of the banks, maybe. Let me see if I could set one up real quick. Actually, this bank, can we do it just because the earnings are going to be the 15th? I'll do it in a bank. Bank stock, let's do it tomorrow while it's closer, but we're going to use these stats. And what we'll do is we'll set up a time spread, and based on that time spread, because here's in JP Morgan, I'll describe it to you right now, and then we'll set it up tomorrow because it'll be one day before earnings. This way it'll be a little bit easier and closer to that earnings date. But here's in JP Morgan, I'm looking at the historical IV crush. So this is looking at a 30-day, an option with 30 days constant maturity, not the near term 30 days constant maturity. So implied volatility on average is down 12% day after earnings. So day before earnings, the average implied vol is 27.2. Day after, it's 24. 5 days after, it continues to decline 23, down a little bit more to 23.5. So what we'll do is tomorrow, we're going to set up where we're looking at an option that's 30 days to go, right, versus near term. What we'll do is then, let me see if I could do it now, I guess. So let's do this. A time spread is you're buying an option in one expiration, selling an option on a different expiration. If you do, you could do it. A diagonal will be different strikes. If you're just doing a straight calendar spread, it will be on the same strike. So let's take a look at JP Morgan. Let's say right now it's at 140. So what if we bought the 140 call? All right. So that's our first expiration. Then let's go out to something that's 30 days. Let me see. So this is 26 days out. So this is 31 trading days. Okay. And let's say we sell this 590. Okay. So this is what this looks like at expiration. If I'm buying the near term, right? I'm buying more gamma. I'm selling the further out term. I'm selling Vega. Okay. So you want a bigger movement, as you could see here, right? You want it to move away from that strike because I'm doing this buy near term, selling the further out. So we want movement in this type of setup. We also know that this is going to, let's say, decline on average, let's say 12%. So I'm going to take it down. Let's take it down 3 clicks. So I'm going to take the implied volatility down from 29.5. Let's just go down 3. 1, 2, 3. Okay, so implied volatility, I'm expecting it to move down 3 clicks. Let's reload the strategy. So this is what it looks like at expiration, right? Let's take a look at what it would look like. I guess these don't have that much to go. So this is what this would look like at expiration, down 3 clicks or down 12% implied volatility. Let's take a look at the last 12 moves and see where they line up here. So these are the last 12 percentage moves. So you could see how many ended up here in the red, right? So if it doesn't make a big move, you know, like 0.6%, 0.7%, looks like JP Morgan doesn't tend to make very big percentage moves after reporting earnings. If it does, it lands out here. So this is a historical distribution of returns after reporting earnings. And this is taking down the implied volatility on average if it's down 12% after reporting earnings. So this is kind of how the time spread would look like. Of course, if I reverse these, you know, it would be the opposite. So let's just say, by the way, another thing before I do that, keep in mind, you know, this is if you do it on the markets, $3.56 credit. The midpoint is $3.72. So you want to get it as close to that midpoint as possible, right? Because even here, you know, you got what is that about? Is that 16 cents, something like that? You know, so it's a couple percentage, but that's a fee. You know, the further away you move from that midpoint, the more fee you're paying to the market makers to play. So you want to get it as close to that midpoint. If you could get the midpoint or even higher, that's better, but as close as you can. So let's take a look. And of course, if you get that midpoint, you know, if you're instead of $3.56, if you sell at $3.72, then this chart looks better because the whole chart moves up, right? Let's reverse it. So I'm selling the front, buying the back. So then this is what it looks like, right? And then we could just plot the 12. So that would look like what it is in reverse. Is that helpful? Like that? If he has questions, let me know, Will. But
yeah, well, oh, I'm sorry. I'm reading. We're getting a lot of chat, but Pavel is asking to him that JP Morgan time spread we just doesn't look like a good trade based on past data is how he's reading it. Do you have any thoughts yourself?
Yeah, well, that's why. Yeah, that's why you have the data there to make a decision and move
there you
on.
go, Pavel. That's the data. And you're
well, it. The good part is that Pavel was able to come to that determination, right?
Yeah.
Otherwise, you're looking at this, right? If you're looking at this, how do you make that determination?
That was great.
Right. Awesome. So that's why you have the data to help guide your decision. Now, anything could look, those are past performance. If something is different about JP Morgan, you know, if you think it warrants a bigger move than before, then you have to compensate for that, right? But obviously that's why you have the data to help you with that, making those types of determinations. I'm just going to take a look really quickly at the implied value just to see how far away JP Morgan is, like, from historical. So if we take a look at, here's JP Morgan, $140. If we take a look at, on average, it trades at a 13 PE in the last 3 years. So if it reverts to that, right now it's at a higher PE. If it reverts to that, we're looking at $100. On average, price to sales in the last 3 years, its multiple is 3.4%. 3.4 times its sales. So market cap divided by total revenue. If it reverts to that historical mean, 128. Let's compare it to SPY. So historically, we're looking at today, JP Morgan's PE is 18.3 versus SPY 34.9. So it's trading at a 48% discount. Historically, on average, JP Morgan's PE is 13.2 versus SPY 25.6, trading at a 49% discount. So if it reverts to that, we're looking at 137. So that's kind of in line. If we look price to sales, that's the PE. If we look at historical price to sales versus SPY, so this is where today we're at 3.7 in JP Morgan versus 2.8 in SPY. So it's trading at a 33% premium to SPY. Historically, the premium is 39%. So if it reverts to that, we're looking at 147. So if we took the average of all these, it's about a 128. So maybe a little bit high, but you could see it's still in the range. If we use the price to sales, then you could say it deserves a higher, between 137 and 147. Let me just take a look at the median. So if we use the median, about 130. So, you could see it is in line. If we're using these, it's in between. Let's look at the 5-year. Let's take a look at the post-earnings drift. So here we see between earnings. So since it last reported earnings up to now, JP Morgan is up 40%. All right, so that's up 40%. That compares to historically, it's, the average, on average, it's up 1.5%, and a standard deviation is 8.2% up or down. So you see that's a 5 standard deviation move. So it did make a big, here's their historical drifts between earnings. So 40% is a big move, but part of that is it might have been just based on its historical mean. It might have been just very low for a long time too, because just based on the implied value, it doesn't look like, it doesn't look to me like it's that pumped up. So those are just other things to look at, when you're trying to see like, well, did it run away too much? Are the expectations very high? Are the expectations very low? So you got other benchmarks to look at.
While you're on the fundamentals, we only got a minute left. We had one chameleon, I won't name names, who was asking about the PE. Would you give a brief explanation of PE?
So PE, that's the multiple of the price you're paying for above what that stock would earn. All right. So how much are you paying over what it would historically, if it earned, let's say in last year, if a stock makes $5 in earnings, right? $5 after paying taxes and everything, you have $5 in earnings. And if you're paying $10 for the stock, well, you're paying 2 times what it earned. Okay. So you're paying 2 times over what it earned last year. So that's a PE. So if the stock is $15 and you're buying it for $15 and it earned $5 last year, paying $3 over what it earned. So that's what the P is, the multiple of what you're paying over the trailing 12 months.
So
earnings.
PE for JPM, you're paying 18 times. Is that correct?
So right now, trailing 12 months, it's 18 times. So sometimes the multiple will go up if they're guiding higher and the expectation is, well, their earnings are going to be, better. So then they give you a higher multiple because you're expecting earnings to go up. So remember, future expectations are being built into that.
Very cool. All right, everyone. Dima, great job as always, bringing the chameleons lots of education today. Thanks, buddy.
Great. All right. Thanks, everyone. Have a great trading day. Stay safe out there. Hope to see you guys tomorrow.
All right, trading